Here are 5 really cheap tech stocks that you do not want to miss for 2024. Starting with number 1, Hewlett Packard Enterprise. Hewlett Packard's ticker symbol is HPE, and this is an American provider of enterprise solutions that allow customers to capture, analyze, and act upon data seamlessly. They do operate worldwide, and the company builds servers, hardware products, cloud management, network management, and security softwares, professional and support services, and asset management and consulting services. HPE sells these products through a consumption-based model and an as-a-service-based model, and the corporation serves large commercial enterprise groups as well as public sector enterprises. Hewlett Packard's forward PE is very low at 8.24, and the company has 3-year revenue growth of 2.59% per year, 3-year earnings growth of 3.13% per year, a gross profit margin that's really nice at about 35%, a return on equity at just under 10%, a return on assets at 3.54%, a Z-score which measures its balance sheet safety at 0.84, which is not good, as we would like to see this number above 1.6, a current ratio at 0.87, which again is not good. We'd like to see this number above 1. And a 5-year expected earnings CAGR of 2.47%. So this is not a fast-growing company, but it is expected to grow. And on top of that, there is a dividend yield of 3.27% for Hewlett Packard. So that is really nice. You will get paid that dividend while you wait for this company to get back to a more healthy growth stage. This is a fairly young company that was a spinoff of HP Inc., but 2023 did help the company deliver a record financial performance. In all cases, they saw year-over-year growth. And what I'd like to draw your attention to is this HPE GreenLake segment, which is up 37% year-over-year, with its as-a-service orders up 23% year-over-year. And this is kind of the main flagship product that HPE is currently going towards. And so it's very important to keep track of how GreenLake is producing, because it should give us a sign of the future performance of Hewlett Packard. In their other business segments, we see that Intelligent Edge is up 45% year-over-year in revenues. Their high-performance computing and AI is up 25% year-over-year. Their storage components is down 1% year-over-year, and their computing performance down 7% year-over-year. And what I found quite interesting is that there is quite a variety in ranges of the year-over-year change in operating profit as a percentage of revenue in each of their segments. What is nice to see is that the 2 segments that HPE is currently trying to focus and shift towards, the Intelligent Edge and the high-performance computing and AI, did see growth in their year-over-year operating profit as a percent of revenue. So I think this is a good sign. It shows that the company is continuing to pivot and transition to a more AI-friendly, cloud-friendly business model. But what is less inspiring is the negative growth in every other segment of the business. So unfortunately, the Intelligent Edge and the high-performance computing and AI segments are not large enough to make up for the slower growth or the negative growth in all of the other segments of the company. So while the company continues to transition, we might still see another few quarters or years of difficulty in growing operating earnings. But do not fear, this Intelligent Edge segment is seeing really good revenue and operating profit growth, accelerating nicely from 10% of overall revenue in 2020 all the way up to about 17 or 18% of overall revenue in 2023. And so if you do want to invest in this company or keep an eye on this company, you are going to want to see this Intelligent Edge revenue as a percentage of the company's overall revenues continue to accelerate and grow. And so to check out the company's pros and cons, I think the number one pro of HPE is that the transition is well underway and it has been successful thus far. So even though the company's bottom line is still being heavily affected by its legacy segments, we are seeing really good growth in the newer AI and Intelligent Edge segments, which provides a lot of positivity, at least for me, in the company's long-term perspectives. Second, the company's valuation does remain quite low, and that is in part due to the time it takes for a transition to take place, the uncertainty with that transition, and the fact that the company also recently secured a deal to purchase another publicly traded company, Juniper Networks. And so companies that just make large purchases tend to see a drop in value, just because that means a little bit of uncertainty about how that transition and that acquisition is going to turn out in the future. And finally, I think it is difficult to overstate how nice it is that Hewlett Packard Enterprise pays a healthy dividend while you wait for it to transition, because 3.27% is quite high in the technology space, and that is a fairly guaranteed return on your money as the company takes time to transition into more growth-oriented segments. So if you are patient, you can just collect this dividend as you wait, and then once the company is able to transition, then you can also start to see much more growth in your overall equity position. But before Hewlett Packard Enterprise goes to the moon, there are some cons that the company will need to address. And first and foremost, the company will need several more years to make the full transition to its high growth markets. And this is expected, and I would not fault the company directly for this, as these things do take time. And that is something that as an investor, you should understand, and you should expect a little bit of a bumpy road as that transition takes place. Secondly, the solvency ratios show that HPE currently has a riskier balance sheet than most other tech companies. And finally, HPE does have low growth expectations for several years. I do think if they are able to make this transition, they will be able to grow at a much higher rate than about 2.5% per year. But with their legacy segments contracting at the same time that they are growing their newer segments of the business, we are going to see on average a pretty slow growth rate for a tech company, at least for the next few years, until HPE's newer segments are able to hit critical mass and they really start carrying the company. Second on our list of 5 cheap tech stocks that you do not want to miss is Celestica. This company's ticker symbol is CLS, and it is a Toronto-based electronic manufacturing services company. They provide support for electronic design and development, engineering services, component sourcing, testing, assembly, product licensing, logistics, and aftermarket repair and return services. They also aid in the development of infrastructure platforms, which include as-is and customizable hardware and software solutions. Celestica focuses on hyperscaler industries including AI, health tech, aerospace and defense, capital equipment, and OEMs or original equipment manufacturers. This company currently has a forward PE of 12.2, a 3-year revenue growth of 10.34%, a very impressive 3-year earnings growth of 55.24%, gross margins at 9.43%, a return on equity of 12.27%, return on assets of 3.53%, a Z-score of 1.92, and a current ratio of 1.43, which both meet the requirements to be a financially healthy company, as well as a very impressive 5-year expected earnings CAGR of 18.7% per year. Now, Celestica's most recent investor presentation does not give a ton of very visual information, but what I did find interesting is that the company has a net debt position of $260 million, which compares really nicely to their forecasted revenue of $2 to $2.15 billion for the next quarter. The company does expect an increase of low single digits in its year-over-year revenue growth from its ATS segment, which consists of the aerospace and defense, industrial, health tech, and capital equipment sectors, a decrease in the mid-teens of their communications segment, and an increase in revenue in the high 20% of their enterprise segment. And this enterprise segment consists of servers and storage, which would be kind of the data center / AI segment of this business. So while businesses are trying to harness the AI explosion that so many people are talking about nowadays, Celestica should benefit nicely because they provide a ton of the build out for the products that run these AI services. This also translates nicely to updated outlooks where the company now believes that they're going to earn higher revenue, higher adjusted earnings per shares, and higher free cash flow for 2023, and they expect EPS growth of 10% or more from 2023 to 2024. And so I think the pros of this company are fairly obvious. I mean, there's huge expected future growth thanks to AI and overall tech spending going on in the world's developed economies. And this provides huge industry tailwinds as new electronics will always be needed as different companies compete, different countries compete, etc. And as a company, Celestica has focused on creating a more stable revenue growth by diversifying the products they offer as well as the number of customers that they serve. And so far, this has done well to make the company's earnings and revenues stay more stable than the competition. What is a con though is that CLS currently has very low return on assets, so that is something that you might want to look into. And secondly, the current stock price does presume very high future growth. So if AI and data center build out continues, Celestica should be able to benefit greatly from this. But if there was a recession of some sort and companies had to put a pause on a lot of their tech spending, the reverse would also be true and we could see a fall in Celestica's earnings or at least much more muted future earnings. Now, before I reveal the third company on this list of 5 cheap tech stocks for 2024, can you please take a moment to like this video and subscribe to my channel, as this really helps me determine what kind of videos you guys like to see. And of course, I cannot wait to bring more content like this to you. Thank you so much for your view. And with that, the third company on our list is Sanmina. This company's ticker symbol is SANM, and Sanmina Corporation is an American electronic manufacturing services company much like Celestica. It offers product design and manufacture, assembling and testing, logistics, direct order fulfillment, supply chain management, and aftermarket support services. Sanmina's customers are primarily OEMs in the industrial, medical, aerospace and defense, automotive, and communications industries. The company has a very low forward PE of 9.38, with solid revenue growth at 8.73% for the last 3 years, and very impressive earnings growth at 40.19% per year. The company's gross profit margin is 8.32%, with a return on equity and return on assets that are very impressive at 16.83% and 15.83% respectively. The company's Z-score of 2.54 and current ratio of 1.91 both pass the balance sheet safety test, but the major holdup with this company is that its 5-year expected earnings CAGR is negative 15%. Now, I do want to say that this negative 15% does come from Yahoo Finance, along with the rest of the expected earnings CAGRs for the other companies, but I have seen Sanmina's 5-year expected growth range range quite a bit from -15% at the lowest all the way up to 10 or 12% per year at the highest. So I do think the greatest takeaway is that there is a lot of unpredictability with the company currently, and this -15% is probably the most bearish and in all likelihood is excessively bearish. The company has seen really strong year-over-year performance with very solid revenue growth, but the thing that I want to draw your attention to is actually their gross profit margins, represented by the blue lines. So from fiscal year 21 to 23, Sanmina has improved its non-GAAP gross profit margin from 8.1% to 8.5%, and its operating income margin from 4.6% to 5.8%. And this margin expansion has been one of the main focuses of the company because their margin in the past has fluctuated quite a bit. So to see this margin growth over the last few years is very positive, and that is a number that you're going to want to watch very closely if you are watching this company or do decide to invest in Sanmina. The company also does have a very good balance sheet with a debt to cash ratio of 0.51, meaning Sanmina could pay off all of its long-term debt and still have plenty of cash left over. On top of that, the company's non-GAAP pre-tax return on invested capital is 26.4%, meaning for every dollar that they invest, they earn $1.26 back. So this is quite impressive, especially for a company that is in the electronic manufacturing services industry. And hopefully Sanmina is able to keep and possibly even expand this very high ROIC number. And finally, I did also want to go over the fact that the company is quite shareholder friendly, focusing very heavily on strategic transactions, then reducing their debt and then repurchasing their shares. So since fiscal year 2014, the company has repurchased 44 million shares for $1.27 billion, which does make a huge difference as a small cap company. On top of that, they do have about $280 million remaining that is authorized to be used on share buybacks, so this company could continue to buy back shares for several more years at their current rate. And so, much like Celestica, the major pro is that there's excellent growth prospects thanks to tech and AI buildouts. What is even better is that the valuation of Sanmina is lower compared to its peers like CLS, and it has very healthy return on equity and return on asset metrics and a strong balance sheet. So overall, I think this company is quite safe, at least from a balance sheet and solvency perspective. On the con side, I did find a major issue in that Sanmina has a very concentrated customer portfolio, and so this means that just 1 or 2 or 3 customers make up a very large majority of the company's revenues. And so this isn't necessarily a bad thing, but if Sanmina was to lose one of those customers, we would see a major hit to their financial performance. Secondly, the negative near-term growth expected is never good, although, like I said earlier, there are a ton of conflicting opinions about this, so I would consider this kind of a neutral negative, more so than an extremely red flag. And finally, the cyclicality of Sanmina's earnings is a much greater concern due to their customer concentration. So when the company and its customers experience fluctuations due to economic cycles, when 1 or 2 of those customers experiences difficult times, they will spend less, and that will create a domino effect where Sanmina will receive much less money, and therefore earnings will also be much lower in these situations. And moving on to number 4 on our list, we have Arrow Electronics. Now, I have no idea why, but when I print this presentation, in order to annotate it, Arrow's logo just does not want to appear. So I'm going to show off my drawing skills and show this really cool arrow as a representation. So yeah, I bet you didn't know I was also Pablo Picasso. But to get back to the video, Arrow Electronics ticker symbol is ARW, and this is a technology distribution company based in Colorado. It markets and distributes semiconductor products such as capacitors, resistors, power supplies, switches, etc., and computing and memory products. Its enterprise solution segment also offers data center, cloud, security, and analytics solutions by providing access to engineering and integration support, warehousing and logistics, marketing and resources, and training for hardwares and softwares. Arrow generally serves OEMs as well as value-add resellers, managed service providers, contract manufacturers, and other commercial producers. The company has a very low forward PE of 6.86, which is even more interesting when you look at the revenue growth at 7.86% over the last 3 years, as well as their earnings growth at over 46% per year. Arrow also has very nice gross profit margins at 12.62%, a return on equity at 19.66%, return on assets of 5.13%, and very safe liquidity scores of 3.2 for its Z-score and 1.45 for its current ratio. Again, though, we do see that the negative is that their 5-year expected earnings CAGR is negative 10% for the next 5 years. And like Sanmina, I did find a variety of predictions from different websites, and Yahoo Finance was the most bearish. So while I don't want to discount the fact that the company could shrink quite substantially, it is certainly not a unanimous expectation. So what I do want to point out in their Q3 2023 highlights is that this company is a semiconductor company, and so this is a cyclical business that is currently going through a bit of a downtrend. But with that in mind, the company's management does expect to emerge stronger when market conditions improve. And from everything that I've seen lately, market conditions for the semiconductor industry as a whole are expected to improve through 2024 and into 2025. Arrow Electronics is quite heavily reliant on sales around the world, and due to the difficulties in the semiconductor industry currently, we are seeing negative growth in every single market that this company operates in. I wouldn't call it necessarily surprising, but it's definitely not positive either. What might be a bit more inspiring though is that the company did have an operating cash flow of $322 million in just the third quarter, and even though their net debt is quite high at about $4 billion, they do have liquidity of $2.3 billion, including $330 million in cash on their balance sheet. So I do think this company is quite safe from a leverage perspective, and with that extra cash, they are repurchasing shares, with recent repurchases equaling about $200 million. So, while things look quite negative right now, there are plenty of positives for Arrow as well. First, the semiconductor industry tailwinds, should prove valuable for ARW, and that is simply because technology is going to continue to become more and more a part of our life, which means more and more semiconductors, which means more business for Arrow. Second, they do have very low forward price to earnings ratios and very strong earnings growth. So even if the next year or two are expected to be down years for Arrow, I do think that a forward PE of under 7 is quite interesting, especially considering the excellent ROE that this company has, which shows that they are very efficient with their money and they make great use of the company's investments. But on the con side, of course, first and foremost is the cyclicality of the semiconductor industry, which means that earnings will be cyclical for ARW, as analysts are predicting. So this does mean that many people expect negative earnings growth in the near term, which although is a negative, you could also see this as a positive because it would theoretically provide a good buying opportunity for this company. And then third, since Arrow Electronics has a very high level of foreign business, this increases their foreign currency risks, which were quite a problem in 2022 when we saw a very strong dollar and basically every currency in the world losing value against the dollar. So obviously when a situation like this happens, all of Arrow's external or foreign business does become less valuable on a dollar basis, but the reverse can also happen where the dollar devalues against the rest of the world's currencies, meaning Arrow's foreign business becomes more valuable to the company on a dollar basis. So this is kind of a double-edged sword, and it's definitely something you need to be aware of, but it is not always a con. And finally, the fifth very cheap tech stock is PagSeguro or Pag Bank. This stock's ticker symbol is PAGS, and PagSeguro is a Brazilian fintech company serving individuals, entrepreneurs, micro merchants, and small and medium-sized businesses. Its Pag Bank offers digital bank accounts, prepaid, debit, and credit cards, and a variety of mobile payment solutions for sending and receiving money. PlugPag offers small and medium businesses the ability to connect their point-of-sale systems to their resource planning softwares via Bluetooth, which makes their lives way easier. PagSeguro also offers payment protection, e-commerce payment solutions, bill payment services, and back office solutions. And finally, the company owns Perifácil, which is a food delivery and order management app. Pag's forward PE is 11.76, and it has an exceptional 3-year revenue growth of 35.65% per year. Its earnings growth has been much slower at 7.28%, but its gross profit margin is very healthy at just under 49%, with a return on equity of 12.91% and a return on assets of 3.32%. The company is currently on the cusp of being in a difficult financial situation according to its Z-score, which of course we want to see at 1.6 or higher, but it's not far off from that, so I wouldn't call it worrisome, especially when we consider that its current ratio is 1.44, which is well above 1 and would be considered safe. What also may be affecting these numbers is the fact that PagSeguro does have a very large portion of its revenue coming from banking services, which do not usually do super well with either Z-score or current ratio calculations, just due to the number of financial things going on with the company's balance sheet. Finally, its 5-year expected earnings CAGR is 2.27% per year, which would signify quite the slowdown compared to its last 3 years of earning growth if it did take place. PagSeguro's goal is to be the one-stop financial shop for every Brazilian. Their aim is to unite one single brand for both merchants and consumers in order to simplify communication, create efficiency gains, and increase client awareness for banking services in other parts of the company's business. PagSeguro's online ecosystem is absolutely massive and is very reminiscent of Nubank, which I did a video on not too long ago, and I will link in the top right-hand corner of this video right here. In fact, PagSeguro is the second largest neobank or entirely online bank in Brazil and is second only to the aforementioned Nubank, which in all honesty does have a pretty decent lead over PagBank. But in its very short existence of only 5 years, PagBank's financial services have grown by 6 times, their credit portfolio grown by 11 times, and their total deposits have grown by 13 times. So very exceptional growth in a very short period of time. The company's payment platform has also grown really nicely, from having a 1% market share to about a 10% market share in the last 8 years. And now, of course, 10% market share is nothing incredible, but it does show a really strong trend in the right direction. On top of that, in Brazil, credit cards have only penetrated about 50% of total consumption by households. And so this means that there is still a very long runway of credit card growth in the country. And obviously, this is what PagBank is trying to capture. The company has seen a 5 times growth in total payment volume per merchant, as well as a 27 times growth in total payment volume. But I did want to make one final note, and that is that the company's credit portfolio is a bit more dangerous than what you would expect from like an American company similar, like, American Express or PayPal or a regular bank. And as I mentioned in my new bank video, this is typical of Brazilian companies in general, and PagSeguro is working very, very hard to make their overall balance sheet more credit-worthy. And as we can see, the year-over-year change in non-performing loans of 90 days plus has gone down quite significantly from 23.6% to 10.7%. And as someone who might only be familiar with American or European banks, that still sounds incredibly high, but it is actually much closer to the average for Brazilian banks. So while I wouldn't call this a good number, I would say that it is at least trending in the right direction, and this is something that we will need to keep our eye on if we do choose to invest in or watch list this company. And so for the final pros and cons of this video, I do think that PagSeguro has an excellent portfolio of products that range all types of financial transactions, so I see it being very useful and able to adapt to many different types of environments that might occur in the future. Secondly, there's absolutely huge growth potential via the Brazilian digital economy adoption, as well as it just being a growing economy in general. So as more people in Brazil start to use credit cards and online banking, that should help PagSeguro grow. And as the Brazilian economy continues to grow, as it is expected to, that would make each individual customer even more valuable to PagSeguro as well. And finally, I do think this company is undervalued by several metrics, especially if their growth picks back up. So like we see on the left, the company did have its earnings grow by 7% per year over the last 3 years, but it's only expected to grow by 2.27% for the next 5. And this doesn't terribly worry me because the company is still in a major growth phase. And as long as that revenue growth continues, the earnings growth is a little less important. But I do think that once earnings growth starts to catch up to revenue growth, this could be a stock that really starts to rocket higher. And for my first con, this is exposure to an emerging market, which means that there's greater potential earnings risk in recessions because, as I'm sure you're all aware, emerging economies suffer the most when there is a global recession. Secondly, competition is incredibly high in the fintech business in Brazil, as I'm sure some of you are aware of the different competitors of PagSeguro like Nubank, ticker symbol NU, and StoneCo, which is ticker symbol STNE. And third, the market share of PagSeguro has slowed considerably, and so this kind of raises the question on, is this pause due to economic slowdown, which did occur over the last couple years in Brazil, or is this a change in trend? So that is definitely something we need to watch out for and see, where does this trend go in the future, and is PagSeguro able to continue to capture more of a market share in the Brazilian economy? So this has been 5 ultra cheap tech stocks for January 2024. I hope you found something interesting and informative in this video, and please do let me know, which companies do you find most interesting from this list? I would really love to hear your thoughts. And so with that, if you have not already, please like the video and subscribe to my channel. And as always, make sure to have a great day. Bye.